If you think the US economy feels confusing right now, you're not alone. Jobs are growing, but hiring is slowing. Inflation is cooling, but still not at 2%. The Federal Reserve might cut rates, or maybe not. Markets are optimistic, but recession fears are still here. So, what is really happening? Today, we're breaking down the real economic situation in the United States as of February 12th, 2026, using actual reports from major financial sources like Reuters, Bloomberg, and federal data. And by the end of this video, you'll clearly understand what's happening with jobs, what the Federal Reserve is likely to do, where inflation stands, and whether recession fears are real or exaggerated. Let's get into it. First, let's talk about the labor market. The January jobs report just came out, and it surprised many people. The U.S. added about 130,000 new jobs last month. That's almost double what economists expected. The unemployment rate dropped slightly to around 4.3%. On the surface, that sounds like strong news. More jobs, fewer unemployed people. That's positive. But here's where things get interesting. Even though new jobs were added, previous job numbers from 2025 were revised downward, meaning the economy created fewer jobs last year than originally reported. So while January looks strong, the overall trend shows that job growth has been slowing compared to earlier years. Another important number is the hiring rate. The hiring rate has dropped to about 3.3%, which is near levels last seen during the COVID slowdown. What does that mean? It means companies are not hiring as aggressively as before. Businesses seem more cautious. They are not firing large numbers of workers, but they are also not expanding fast. So the labor market is stable, but not booming. Now let's move to inflation. Inflation has been the biggest issue in the U.S. economy over the past few years. The Federal Reserve has been fighting inflation by raising interest rates. The good news? Inflation has slowed compared to its peak. The bad news? It is still above the Fed's 2% target. Core inflation, which excludes food and energy, remains slightly elevated. That makes the Federal Reserve careful. Why does this matter to you? Because interest rates affect everything: mortgage rates, car loans, credit cards, small business borrowing, stock market performance. Right now, markets are expecting the Federal Reserve to keep interest rates steady at its next meeting. Earlier, many investors believed rate cuts would start early in 2026. But because the jobs data came in stronger than expected, those rate cut expectations are being pushed further into the future. In simple words, the economy is strong enough that the Fed doesn't feel pressure to cut rates immediately, but it's not strong enough to say everything is perfect. Now let's talk about growth. Economic growth in 2026 is expected to be moderate, not explosive but not collapsing either. Forecasts suggest GDP growth around 2% this year. That's considered stable growth. Manufacturing activity has improved slightly after months of weakness. Some business surveys show companies are becoming a bit more optimistic. Consumer spending remains steady. Americans are still spending money, but more carefully than before. Credit card usage remains high, and savings levels are lower than during the pandemic years. So consumers are still supporting the economy, but they are not as comfortable as before. Now here's the big question everyone is asking. Is a recession coming? Right now, there is no official recession. The economy is still growing. Jobs are still being added. Unemployment is relatively low, but some warning signs exist. Hiring is slowing. Job growth revisions show weakness. Businesses are cautious, and high interest rates are still putting pressure on borrowing. This creates a mixed picture. It's not a crisis, but it's not a boom either. It's what many analysts are calling a slowdown without collapse. Now let's talk about financial markets. Stock markets have reacted positively to the latest data. Investors seem encouraged that the economy is not falling apart. However, markets are very sensitive right now. Every inflation report, every Fed statement, every employment number can quickly change market direction. Bond markets suggest that investors still expect rate cuts later this year, just not immediately. The US dollar has been slightly volatile as traders adjust expectations. Gold prices moved lower recently as strong jobs data reduced fears of immediate rate cuts. Everything right now depends on data. The Federal Reserve has made it very clear they are data dependent. If inflation continues falling, rate cuts could come later this year. If inflation stalls or rises, rates could stay higher for longer. Now let's talk about what this means for everyday Americans. If you are looking to buy a house, mortgage rates are still relatively high compared to a few years ago. If you have credit card debt, interest costs remain expensive. If you are a business owner, borrowing is still costly, but if you are employed, the job market is still holding up. The biggest shift happening right now is stability. We are moving from extreme conditions, extreme inflation, extreme stimulus, extreme rate hikes, toward a more normal economic environment. But that transition takes time, and during transitions, uncertainty is high. That's why you hear mixed headlines. Some say the economy is strong, some warn about recession, some predict rate cuts, some say rates will stay high. The truth is somewhere in the middle. Here's the honest summary of the U.S. economy as of February 12th, 2026. The labor market is stable but slowing. Inflation is cooling but not fully controlled. The Federal Reserve is cautious. Growth is moderate. Recession risk exists, but not immediate. This is not a crisis economy. This is not a booming economy. This is a balancing economy. Now, here's what you should watch going forward. Number one, inflation reports. If inflation drops closer to 2%, rate cuts become more likely. Number two, job growth. If monthly job numbers fall below 100,000 consistently, recession fears will increase. Number three, consumer spending. If Americans start cutting back heavily, growth will slow faster. Number four, Federal Reserve communication. Every speech and press conference matters right now. The next few months will be critical. The U.S. economy is at a turning point. It could move toward a soft landing, where inflation falls and growth continues, or it could slow more sharply if consumer or business confidence weakens. Right now, policymakers are trying to achieve balance, and balance is difficult. Before we end, let me say this clearly. Economic headlines can sound dramatic, but the real economy moves gradually. There is no sudden collapse happening. There is no massive boom happening. We are in a period of adjustment. And adjustment periods often feel uncomfortable, but they are part of the economic cycle. If you found this breakdown helpful and clear, make sure you like this video. If you want simple, real updates about the US economy without complicated language, subscribe to the channel and comment below. Do you feel the economy is improving, or does it feel tougher than the numbers show? I'd love to hear your perspective. Thanks for watching. Stay informed, stay smart, and I'll see you in the next update.